Hello and welcome to today's webinar presented by Greg Wank, an executive partner at Anchin. In addition to this session, Anchin has put together a COVID-19 update center housing the latest information on the impacts and opportunities related to the outbreak. You can find that at anchin.com. We will also make the slides available to you following today's webinar. We welcome live questions and insight from you and encourage you to submit questions through the question box in the GoToWebinar platform at any time. If you encounter any issues throughout the presentation, please send us a message or email us directly at events@anchin.com. Thank you, and I will now turn this over to Greg Wank.
Great, thank you, Ashley. Good afternoon, everybody. Our goal this afternoon in a short time is going to be to review where we are with the PPP program, start to talk a little bit about forgiveness and how that might work. I'll preface that with saying that the final rules surrounding loan forgiveness have not yet been issued. So when we get through these, I'm sure there'll be many questions, unfortunately without definite answers. Under the CARES Act, the SBA had 30 days to issue the rules surrounding loan forgiveness, and that will include, hopefully some very important clarity as we go through. You'll see there's still some things that are not entirely clear. And then lastly, we're going to just spend a few slides talking about the Main Street lending program that the Federal Reserve announced late last week, just to make everybody aware of what that is. That's not PPP at all. But it was authorized under the CARES Act, so we'll touch on that as well. Next slide, please. So we're going to go through 4 questions, which is appropriate, I guess, for those celebrating Passover, that we have 4 questions. And then we'll get into the loan forgiveness and the Main Street program. Next slide, please. Okay, so what is the PPP? Some people may not understand that this program is actually available through June 30th, and there are many companies that have still not yet applied for various reasons. So the program was created under the CARES Act, which passed on March 27th. It was for small businesses defined specifically as having 500 or fewer employees, subject to other exceptions and things we'll touch on, to provide up to $10 million of funding to help them cover the payroll and other essential costs like rent and utilities. Even though the program is open until June 30th for new applications, there is a cap. Congress authorized roughly $350 billion for PPP loans. There's been much written this week already about Congress trying to negotiate additional funding. As of late yesterday, the Wall Street Journal reported that close to 2/3 of the money has already been approved by the SBA, and a lot of that has been dispersed. So if they're correct, that would leave roughly $100 billion or so that's still available, but I'm sure there are more applications being approved as we speak. So the application window opened on April 3rd. Many have received their funds to date. Are you still looking for a lender? There were many issues surrounding who could originate a PPP loan. Unfortunately, the CARES Act initially said any lending institution that's already certified by the SBA can originate these loans. And then they decided over the course of the next week that wouldn't be enough institutions, that it would be overwhelmed. So we're going to also expand it. We're going to get banks who normally weren't SBA lenders involved. So they had to apply and get themselves set up and running. So that created a little bit of chaos, with many banks telling their customers, we're going to accept, we just don't know when. I think notoriously, some banks never quite launched their sites. Others launched, but then took them down shortly thereafter. So there are some companies out there who called their existing bank relationship, and their bank told them, we're only going to loan you the money if you're an existing borrower. It's not enough that you just keep your checking account with us. While we appreciate that, we have to focus on borrowing clients first. So there's a lot of this going on, unfortunately, over the last couple of weeks. Hopefully you've been able to find an institution to take your application by now. If you have not and don't know where to turn, you can email our COVID-19 team and we'll share with you some ideas that other clients have shared with us. And then just starting this past Friday, independent contractors and self-employed individuals were able to start applying. Next slide. So let's get into our 4 questions. There were many more than 4, but we just picked 4 that were hot topics of debate and that were clarified by the Treasury Department. Our small business concerns with 500 or fewer employees. So that was the general requirement. However, there are exceptions. In addition, the SBA has had already for many years a guidebook on certain industries that don't have to be less than 500. For example, apparel manufacturing, if you happen to still be manufacturing apparel in the United States, your limit's 750 according to the SBA. So there are exceptions in that guidebook, particularly focused on manufacturers. They tend to have higher limits, 750 or 1,000. Some types of manufacturers can even have up to 1,250 employees and still qualify. Next slide, please. So this is around the affiliation rules. Our lender is required to make a determination about your affiliation requirements. So what the CARES Act said was that basically you're self-certifying that you've conformed with the affiliation rules, and they're quite substantial. The affiliation rules guidebook alone is 23 pages. You'd think affiliation would be pretty clear, but it's not clear. There's a lot of different ways that related parties or seemingly unrelated parties can be considered an affiliate of yours, and therefore you would have to count all of these companies that are affiliated to test whether you're an eligible small business. These really are complex and they require consultation with legal counsel. Next slide, please. Okay, this is an important point because we got this question a lot regarding sick leave. So PPP loans certainly cover all payroll costs, including vacation, parental, family, and medical and sick leave. However, if you've availed yourself under the Family's First Coronavirus Response Act, the FFCRA, that passed about 10 days before the CARES Act, and you're taking that credit for people that can't work due to family leave, you can't count their payroll in your payroll costs for PPP. All right, so the CARES Act specifically prohibited double dipping because they figured, well, you're getting the credit that's covering half those wages anyway, so you shouldn't be able to borrow against those wages as well. Next slide, please. If I receive a PPP loan, am I also eligible to defer my employer Social Security tax expense? So the IRS just clarified this over the weekend or Monday morning. So there was some uncertainty. So what this is, just so in case you're not aware, they also create in the CARES Act that employers can defer their half of Social Security taxes on their employees starting March 27th. And those deferrals will be interest-free, penalty-free. So it's basically an interest-free loan from the government for the 6.2% that you have on your employees' wages up to the Social Security limit. And then you have to pay back at least half by December 31st of 2021. and then the balance no later than December 31st, 2022. This is going to be a deferral that you're going to claim on your payroll tax returns. So the IRS came out and said that this will be available on Q2 941s and other reports that companies use to figure out their payroll taxes. And they also said that everybody's eligible for this deferral until you get a forgiveness of your PPP loan. So at that point, once they've forgiven your loan, which can be no sooner than 8 weeks after you get your loan, and most likely will be after that because the lender is going to take time to approve it, you can defer. Okay, so you should be in contact with your payroll provider about how to make sure you take advantage of this if you choose. You know, it's not, it's an interest-free loan. You'll have to pay it eventually. Next slide, please. Okay, so let's take a look at loan forgiveness. And what this is all about. And we're not going to go into every last detail of this because that would take hours. So I'm trying to give you a brief overview of how this will work. So anyone who receives a PPP loan is eligible to apply for forgiveness. And it's very important. I highlighted apply because it's something I don't think people were focusing on. The CARES Act was very specific that this will be an application process. So the SBA, as I said in the beginning, not only still has to issue rules around forgiveness, but they also have to issue the actual application form, which doesn't exist yet. So presumably in the next several weeks, we'll have a form that'll be available for lenders to use to take your loan forgiveness applications, which you cannot apply for until your 8 weeks have expired from getting your loan. Loan proceeds are used to cover qualified payroll costs. So payroll costs are very specifically defined in the Act, and there's been a lot written on that, and we have a lot of material on our website. If you're not familiar with all those components of what's payroll costs under the Act. In addition, mortgage interest, rent paid on leases, and utility costs. All these expenditures over the 8-week benefit period that starts the day you get your money. Okay, so everybody's 8-week period is going to be different. I read something as recently as this morning from a reputable firm, professional firm, saying that companies are going to be able to choose their 8-week period. That's not true. Okay, the way the CARES Act is written, it's very specific, and the Treasury Department clarified this in their own FAQ that they updated yesterday. And if you're not aware, let me mention that for a minute. If you go to treasury.gov, there is an FAQ that the Treasury Department is keeping updated. Okay, so they originally released it. It had 16 questions last week. It's now got 25 questions and counting and answers. And many are using that as authoritative guidance since it's coming from the Treasury Department. So the Treasury Department clarified yesterday that your loan forgiveness 8-week period starts when you get your money. Once you know how much you've potentially can get forgiven based on how you use the money, you now have to do other tests based upon employee headcounts, compensation levels, and we're going to get into these in a little more detail in a minute. In addition, something that was not in the CARES Act, but was added afterwards in the SBA guidance when they realized how overpopular this program was going to be, that not more than 25% of your loan amount or the amount that is ultimately eligible for forgiveness can be used for the qualified non-payroll costs. So if we have to look at this now as 2 buckets of qualified spend: your payroll costs as defined, and then your mortgage or rent and your utilities. That second bucket with the non-payroll stuff is capped at 25% of the qualified amount. Next slide, please. Okay. So the maximum amount of your loan that is eligible for forgiveness. Okay, so big misunderstanding I think a lot of people have is as long as I spend all this money in 8 weeks, the way they want me to spend it, I will get it forgiven. That's not necessarily true. If you do that, you have 100% that's eligible to be forgiven. Excuse me. But then there are other tests that we're going to get into in a minute. So the maximum amount eligible forgiveness are going to be the payroll costs. Again, salary, wages, commissions. No one employee can count more than 100,000 on an annualized basis. Then you add your group health benefits, any paid sick leaves or retirement benefit contributions that you've made for your employees, and the state or local taxes assessed. So if you contribute to state unemployment, you contribute to, in New York, you contribute to MT tax, those would be eligible spend. All subject to further guidance, obviously. And then the other parts are interest, rent, and utilities for arrangements that were in place as of February 15th. Okay, so you can't sign a new lease for with a landlord today, not that anybody would, but if you did, that wouldn't qualify. Okay, it has to be contractual obligations that were in place as of February 15th. Same thing with your utilities, which in the definition, they've included internet. So for example, if you have internet service for your business as of February 15th, that counts, but you can't upgrade it today to a more expensive one and have that count. You're going to have to look back at what you had in place as of February 15th. That's the way the rules were written. Again, also subject to further clarification. Next slide, please. Okay, so now what happens? I've calculated the amount eligible for forgiveness. Now, how do I make sure I get all of it forgiven that I qualify for? Okay, you have two tests. You have a headcount test and a salary or a pay rate test. Okay, so the reduction to loan forgiveness will be made if your average number of FTEs during the 8-week period is less than that average number during your look back period. And guess what? You get to pick your look back period between two choices. So you can calculate your average FTEs for the Feb 15 to June 30, 2019 period, and also calculate it for January 1st to February 29, 2020. Whichever's lower you could use, that'll be your test period, okay? The average number of FTEs per month is calculated based on the average number of FTEs during each pay period that falls in that month. Okay, so that's how you would test it. So it's, if you pay twice a month, and in 8 weeks, you're gonna have 4 payrolls, you're gonna look at your average head count in each of those 4 payrolls and divide it by 4, and that'll be your average head count, FTE head count, remember. There is a safe harbor, okay? This reduction can be avoided if your reduction resulted from layoffs that occurred between Feb 15 and April 26th, and you restore that head count by June 30th. So let's say, for example, your base period average head count is 20. And let's say you laid off 4 people between February 15th and April 26th. So now you have 16 people during your 8-week period. If you hire back those 4 people before June 30th, it doesn't have to be those same 4 people. But if you add back 4 FTE jobs by June 30th, your head count will count as 20 for this test, okay? So you'll have lower eligibility for forgiveness because you're only carrying 16 employees instead of 20 during the 8 weeks, so your spend is less. But the percentage forgiveness, you can still get back to 100% of that eligibility by restoring those jobs by June 30th. Next slide, please. Okay, the second test is based on decrease in salaries. Now, this one is really not going to impact very many people because it only kicks in if the pay rate is less, has been reduced by more than 25%. Okay, so the first 25% reduction in pay rate does not count for this test. Okay, you basically, as long as the reduction is 25% or less, the test result here will be 100%. This will not reduce your eligible amount for forgiveness. Okay, but if you put through a more substantial pay cut on your people, again, you're going to have much lower spend. But you're going to get a double whammy if you don't restore it by June 30th. Okay, so think about it. If you've cut everybody's pay by half, your eligible loan amount, let's say, might only be 50% of your loan because your pay costs were so much lower, just using an example. If you don't restore those pay rates by June 30th, you're going to take half again because this test is going to result in 50% reduction of the amount eligible for forgiveness. So in that example, if you don't restore the pay rates by June 30th, you would only qualify for 25% loan forgiveness in that example. So don't let that happen to you. There's no reason to make that happen. You can restore the rates by June 30th and get out of that. Next slide, please. So what happens to what's left? All right, I've gone through and I've figured out my forgiveness. I've applied for it. My lender awarded me whatever amount, let's say 90% of my loan, and now I have 10% left over. What happens to it? Well, it becomes an actual loan that you have to pay back. The Treasury Department has said it'll be a 2-year loan with interest at just 1%, and that there'll be a payment and interest payment holiday for 6 months. Okay, so those will be the terms. The Act further provides that the amount forgiven will be tax-free for federal purposes. Now, before I get to what's in parentheses, let's just be clear, because some people were really excited about this, saying, okay, I get $1 million loan, I get $1 million forgiven, I used the $1 million, I spent it. I get to deduct all those costs on my tax return that I spent the $1 million on, but I used their money and I don't have to show it as income. Okay, that may not ultimately be the case. The Internal Revenue Code generally says that things directly related to tax-exempt income themselves are not tax deductible. Okay, that's like something that's in the code for forever. Okay, so we're going to wait for guidance, obviously, from the IRS and the Treasury Department on this, and this won't impact anybody really until 2021 when you're figuring out your 2020 taxes. But I just wanted you to be aware that this may just be a complete pass-through wash, that the amount forgiven is basically going to offset the costs that you incurred. So it's a wash. New York just passed their annual budget. In it, they specifically decoupled from any changes to the Internal Revenue Code since March 1st. Okay, now that means some of the tax code adjustments that were made in the CARES Act, which I'm not going through in this presentation, but things such as correcting the 15-year leasehold improvement property now being eligible for bonus depreciation, or increasing the business interest deduction limitation from 30% to 50%. New York State says no, not for us. We're not installing those changes because those are actual changes to the code that occurred March 27th. The tax-free treatment of loan forgiveness has not been codified yet in the Internal Revenue Code. It's semantics, I know, but we're not really sure if the states are going to decouple or not. All right. The way New York wrote their Budget Act, it would seem to imply that almost anything that the CARES Act did, we're not going to go along with. But when you read in between the lines of what the Budget Act said, it said changes in the Internal Revenue Code. So we just have to wait and see how the IRS codifies PPP loan forgiveness to see if New York and New York City are decoupling or not. So we won't know that for a while. Let's just look at a couple of questions before we move on to the next spot here. So unlock the panel. Here we go. What's the likelihood of an increase in the PPP program should they run out of funds? So as of this morning, the Democrats and Republicans are at a stalemate. The Republicans wanted to fast track an additional $250 billion of funding for PPP as a standalone amendment. The Democrats, who control the House and whose votes are needed in the Senate, basically said, no, we're not going to do that. We want an omnibus bill. We want a much more broad bill that goes well beyond just shoring up PPP. We also want a lot of other things. And so far, the Republicans and Senator McConnell have stalled. So as of today, there is no more funding. The pressure will increase if the SBA announces by the end of this week that they've spent 80 or 90% of the money already. I would imagine that will increase the pressure. But these programs are finite. So there it is possible that you could apply late enough that you would not get the full amount of your PPP. Let me give you an example. Something that has been much publicized since the COVID-19 outbreak, so way before the CARES Act, weeks before the CARES Act, was the SBA Economic Injury Disaster Loan Program, EIDL. That program's been around a long, long time, okay? Once the federal government declared certain areas disaster areas due to COVID-19, businesses in that disaster area were now eligible for EIDL if they've been economically injured. And a lot of companies over the past month or more, 5 weeks, have gone on to the SBA website and applied for EIDL. EIDL is not funded. Okay, the SBA has reported that they've received applications that would probably require more than $100 billion of funding. Excuse me again. Yet the program only had $7 billion of fund available. So what they wanted to do was advance $10,000 to each applicant as a grant, realizing that they're suffering economic injury. Let's at least give them $10,000 within a few days of their application, and at least they get something while we wait for funding to give them a bigger loan. Well, as of today, very, very few companies have been advanced this $10,000. In fact, yesterday, many companies reported getting a fraction of the $10,000. That the SBA now is rationing this $10,000 per applicant because that would spend all the money too fast. Some companies got $4,000, $2,000, $7,000, depending on the size of the company. The SBA has come up with some formula that I don't know what it is, but there's an example of a program that's not funded and what the SBA does in response. So, you know, as they approach fully spent, I would imagine they're going to start rationing and not give you all of your PPP loan amount. We're not aware that they can take it back at all. So once you've gotten your loan money, we're not aware of any case where the SBA has clawed back any of it. Let me see. I think so far that's the only question that's not about actually how to operate the site. So let's advance to the next slide, please. So let's talk a little bit about Main Street loans. Okay, so the CARES Act authorized the Federal Reserve to fund something called Main Street lending, in quotation marks, because Main Street lending is something that was created, again, many, many years ago by Congress and the Fed. And I guess it gets turned on from time to time based upon what's going on in the economy. So it specifically provided up to $600 billion to support the Fed, to support lenders, to keep liquidity going to businesses. Okay, so there's two components to it. One is the expanded facility program. So this is for companies that already have debt facilities with lenders. And second is the new loan facility, which is for companies that may not currently have loans with these lenders or Main Street loans. Okay, so I already mentioned it's $600 billion. The idea is to help companies who are dealing with COVID-19 under favorable terms, and we'll get into what those terms are supposed to be. And the way this is structured, so this is not an SBA guarantee program. This is the Federal Reserve itself. The Federal Reserve will actually purchase 95% of these loans from the lender. So they're basically saying to the lenders, look, we understand you have to do your underwriting, but just understand that any loan you originate under Main Street lending between now and September 30th, we'll buy back from you up to 95% of it. So you're only going to carry 5% of the risk. Okay, so then what they're hoping on and counting on is that that will make liquidity a little bit easier to come by for small and mid-sized businesses. Next slide, please. So who's eligible for a Main Street loan? Companies with up to 10,000 employees or companies with less than $2.5 billion of revenue last year in 2019. Okay, they must be U.S. entities. They must have U.S. employees. Firms that have taken advantage of the PPP loan may also take out these loans. They are exclusive. So this is not double dipping. Again, the PPP is under the SBA and the U.S. Treasury, and this is under the Federal Reserve. The terms that they spelled out, 4-year maturities, no amortization for 1 year. The rate is basically going to be determined by your lender between 250 and 400 basis points over the overnight financing rate, which today is 0.01%. So it's basically going to cost you between 251 and 401 basis points. Loans are going to be between 1 and 25 million for new borrowers. The cap for existing borrowers is much higher. But there's also another cap, 4 times 2019 EBITDA. Okay, and that's going to include any existing debt. So it's like a leverage ratio. The applicant is going to have to look at existing debt, including guaranteed availability on the credit line. So even if they haven't drawn from it, if it's a guaranteed available line, they have to count that. And they'll be capped at 4x their 2019 EBITDA. Next slide, please. Okay, what are the strings attached? There'll be a certification where you're going to say that you are not going to use this money to retire old debt, that you're not going to pay other debt ahead of this debt unless contractually obligated to, that you will use the proceeds as best as possible to maintain your payroll and maintain your employees. You're also going to be subject to certain restrictions, such as limits on distributions to owners and executive compensation. Okay, so there are strings attached that you should understand before you go ahead and close such a deal. Very important, the comment period ends this Thursday. So this program doesn't exist today. If you called your bank and said, I want a Main Street loan, they're likely going to tell you we're not ready yet, just like you heard leading up to the PPP application. So the Fed has created a comment period. It's on their website. You can comment as a business owner on your thoughts on what they've laid out. Once the comment period closes this Thursday, presumably there'll then be some negotiations between the Fed and the banks on how exactly this will work. So these loans may not even be able to be applied for a few more weeks. No way to know just yet. Next slide, please. So we have a COVID-19 response team at Anchin. I'm one of the leaders of that group. We have our own email address, our own dedicated page on the Anchin.com website. If you go to Anchin.com and look at COVID-19 response, learn more, you will see everything we've put out since this crisis started in the first half of March. We have specialists all across different disciplines because some stuff is tax driven, some stuff is loan driven. So we have different types of experts to support you in your needs. So if you have any questions, you can feel free to email that email address. Or we still have time right now if you want to submit questions on the GoToWebinar site. We have a question, can I do both PPP and EIDL? So the answer to that is yes as well. EIDL it is independent. In fact, in the CARES Act, they said if you have an EIDL, you could roll it over into your PPP. Now, practically speaking, that really couldn't happen because they haven't been consummating these EIDLs fast enough for anybody to do that. But yes, you can apply for both. So if you're still looking for relief funds due to economic injury to your business, yes, I would go to the SBA website. There's a link directly to their application, which is fully online. There is a checkbox that says, would you like up to $10,000 advanced to you on an emergency basis as soon as possible? You check that box. That makes you eligible for this grant. There's up to $10,000. If you ultimately get approved for a loan under EIDL, they'll subtract the $10,000 from your proceeds. If you don't consummate an EIDL or you don't get approved, you don't have to pay back the $10,000 or whatever you get out of the $10,000. It's free. We have a question, must the PPP be offset against the EIDL? No, it doesn't have to be offset. You actually, the formula was calculate your PPP eligible loan amount based upon your payroll and then add to it the balance of your EIDL loan. So they actually go on top of one another. Let's see, there's another question just popped up. My bank still does not have the PPP application up on their website. Terribly sorry. Can you recommend alternative lenders to contact since the program is maxed out? So there are many banks that we have become aware of over the last 2 weeks or 11 days who have been accepting applications from non-pre-existing customers. Some banks are quite small. Others were substantial banks. I know for a fact Key Bank, which is quite a large bank, did not restrict their applications to only existing customers. So if you contact Key Bank, they will first have you open an account there. Obviously, you have to become a customer because you need an account there for them to wire the money into once you get approved. But what happens is after that, they would take your PPP application. That's just one bank I'm aware of. There are many small banks. If you email the COVID-19 address, we'll email you a few links. We don't endorse anybody, obviously. We're not recommending anything. Full disclaimer there. We're just aware that these lenders have been processing applications. Let's see. The SBA does not have a follow-up facility for EIDL that I can find. I've been given an 800 number to call. Said I should only get an email. Okay, so this is what's going on with EIDL. So there are companies that have applied a month ago I have clients that applied over a month ago. All they have is a loan number. They got an email or a screenshot, I guess, when they logged in. It gave them an EIDL loan number that supposedly you could use to track. However, when you track it, nothing happens. You don't know anything about it. And that's unfortunately what's going on. We do know, again, as of this morning, that the SBA is advancing these grants. So the money's starting to flow. A couple of them I can tell you, because I had seen this morning. The EIDL application was submitted March 15th, and they got their grant on April 10th. That's one example. And they got 6,000. They didn't get 10,000. Here's a company that submitted on March 17th and got 10,000 on April 10th. So these are just self-reporters of who's going of what's going on in real time with the EIDL. Let me just get back to the questions here real quick because I popped them off. If I'm at a staffing firm and I bill my customer for employee costs, is my payroll still eligible for forgiveness? So it's a really good question. I can tell you that I personally do not have experience with staffing firms. What I would speculate, based upon the spirit of the program and other guidance from the Treasury, your employees are really the people that you employ to help run your business. Your employees that you're billing through to your customers, I think would still all be eligible because they're your employees, unless your customers are trying to claim them. So that's something, you know, they came out with a clarification for companies that use PEOs, for example. And they said companies that use PEOs, the companies should claim those people, not the PEO. Okay, they did not issue guidance though about staffing firms. My guess would be that they would all count for you as your employees. However, that might put you over the 500 threshold and not be eligible, because I don't see how me as a customer of yours who pays your temp agency could possibly claim those people as payroll costs, because I don't have payroll registers to show them to support it. Let me just see if there are any other questions, and then we'll wrap this up. Has anyone, to your knowledge, received PPE money from Chase? Yes, absolutely. Chase started advancing money last week. I personally have clients that got funded late last week by Chase, and I know many companies got funded yesterday by Chase. So that is happening. Do you need to establish a separate checking account for which to administer your proceeds? So this is going to be prescribed by your lender. Some lenders have said you have to keep it in the account we wired into. Other lenders don't care as long as you keep it at their bank until you need it. So it's been kind of something that we've been telling clients, not a bad idea if your lender will let you to open a segregated account so that you can easily track the disbursements for payroll, utilities, and rent. It'll be very simple. Can you do both PPP? We answered that question. And and just a thank you. You're welcome. I appreciate that. So if there are no further questions, that was the last question. Oh wait, we have one more, sorry. I don't know why they're not appearing in the order they're being submitted. Here we go, I'll fix it. We do have two more questions, sorry. If we are in a state that has mandated we close our business, should we defer taking the funds as long as we can, hoping for a lift of the closed mandate? So this is, you know, this is a question we've started to get as people now start to think about when they're going to get their money. We had a couple of companies yesterday say, You know, I called my lender and said, I don't want my money yet, you know, because I don't need the employees right now. I want to wait, you know, and that's not going to work. You know, the SBA basically only has 10 days to fund once they approve an application. That's a Treasury rule. So there won't be any delay once you apply. Now, if you haven't applied yet, you certainly can wait. If you think your spend over an 8-week period in the future is going to be greater than the 8 weeks that would start now, I understand that. But your risk is that they run out of funding. And what Congress wanted was for you to hire back as much as you can with this money between now and June 30th. So they realize that there are going to be many companies that are going to be paying these people to do not much of anything from home. Hopefully you can find things for them to do that'll be productive in the meantime. Otherwise, you're really just a conduit. You're taking the government's money and giving it to your employees if you're worried that it's going to run out of money. We applied to cabbage.com and they're asking for our bank account. Is that safe? I have no idea about cabbage.com. I do know that the SBA is electronically transferring the funds. So if Cabbage is an authorized lender, I have no idea if they are, they do need a bank account to tell the SBA to send the money to. So it's a fair question whether it's safe in their hands, and I couldn't tell you. Clarify 8 weeks starts. Yes, it starts when you get funded, not when you get approved, but when you actually get the money. Will a copy of this presentation be available to us? Yes, we will email the slides to everyone who registered today. So that'll be available to you. And we have a comment that banks are asking for more time with this 10-day rule because they cannot possibly process the applications fast enough. I'm not shocked. And I would imagine we'll get some update on that FAQ tomorrow and maybe again Friday on tweaking these rules. Thank you all so much for your attention this afternoon. And again, please don't hesitate to reach out to us at covid19@anchin.com for further questions. And I wish you all good health and stay safe.